Now it's time to make the decision on itemizing versus taking the standard deduction. Another term for itemized deductions are below the line deductions. And if you're looking on screen, you're looking at a screenshot of some of the ones we talked about last week. So let's talk about some ways that we can optimize this so that if we are trying to make that decision, we give ourselves the best chance of having deductions that exceed what's available with the standard deduction. For example, when it comes to charitable deductions, the obvious way that you can benefit your itemized deductions in this area would be to make those charitable deductions, but it doesn't necessarily have to be you going out and finding a charity that you're going to give money to on a monthly basis. You could do a concept called bunching deductions, where instead of spreading out your deductions over the course of several years, if you're thinking that this year you're going to take the standard deduction, maybe you don't make as many charitable contributions this year, and you take everything that you were going to contribute and you add it onto next year's planned charitable contributions. That increases the total that you have in the tax year 2026, which might put you in a position where you're giving to charity and benefiting from a tax perspective by itemizing your deductions. So the concept of bunching deductions is essentially saying, if I'm not going to itemize this year, let me take that amount, add it onto a future year, and in that year, I increase my odds of benefiting from itemizing. Another way that people will do this if they're trying to get some benefit from charitable contributions every single year, but they do not necessarily have a nonprofit or a cause in mind that they want to contribute to in the here and now, is what's called a donor advised fund. We'll do an episode on this down the line, but the concept of a donor advised fund is it's an account that you can open up now. You can contribute money to that account and you can take a tax deduction in the year in which you contribute, even if you do not have those funds dispersed to a charity in that same year. So for example, I can put money in a donor advised fund. That money can be invested in the market. And if I contribute in the year 2025, I get a tax deduction for that charitable contribution in 2025. Now, let's say that 2 years later in 2027 is a charitable cause that catches my eye, and I decide that I want to make a $3,000 distribution from my donor advised fund to that charity in the year 2027. Well, I got my tax deduction in 2025, even though the funds weren't distributed until 2 calendar years later. Next up, we have state and local taxes. And while there may not be as much that you can do in terms of how much you pay in state income tax, when it comes to property taxes, if you do not have your taxes escrowed into your mortgage payment and you've decided to pay them on your own, you may prepay your property taxes so that you can take advantage of the itemized deduction now. Next up, medical expenses. And this is one where it's kind of similar to the process that you go through when you're talking about federal student loans. Medical expenses are things that are tax deductible to the extent that they exceed 7.5% of your adjusted gross income. Now, for a high income earning couple, it may take a lot of medical expenses to exceed 7.5% of adjusted gross income. But let's say that you're planning to have a child this year, or you're planning a major surgery in this year, or any other medical expense for one of you in the household that you know is going to be costly. And if you filed your taxes jointly, it still would not exceed 7.5% of that adjusted gross income. But if you filed your taxes separately, that's a different and lower bar that may allow you to benefit from those expenses in a tangible way. Now, it would still have to be, in my opinion, some pretty substantial medical expenses. But again, if these are pre-planned things where you can project ahead and you're working with a tax professional, you can have them run the numbers. And maybe if you have other scenarios that might benefit you to file separately, these are the types of areas where some pre-planning can save you some significant funds in the long run.